I was here a year ago, and I moderated the panel on corporate venture capital. And a year ago, I thought there's never been more attention on corporate venture capital, fever pitch of activity, and not sure where it was going. Felt, to use a term I heard this morning, a little bubbly. A year later, here we are. I'd say it's even ramped up more. So we're going to find out where this is all going with a great panel. So let me do the introductions briefly, and then we'll launch right in. So Glenn Fogel, immediately to my right. I think most of you were on in for the last session, so Glenn sort of introduced himself, so I won't repeat that. But we were talking last night, since Glenn joined the company and did all of those acquisitions and investments, and the company has grown from about a $30 billion market cap, going down to a near-death experience up to over a $60 billion market cap today. Quite a huge achievement over that period of time. To Glenn's right is Christine Herron, Director of Intel Capital. Christine has been an investor with Intel and also an entrepreneur. If you look on her bio on the PreMoney site, you'll see a host of companies that will be familiar to you. So she's been on both sides of the table and brings that perspective, including spending time as a seed investor with first round capital and some others. So currently her focus is on internet and digital service companies. So great to have Christine with us. And then to Christine's right is Eddie Chen, Director of Strategy and Corporate Development at VMware, where he's been since 2010. And Eddie's coverage includes M&A and investments. And during his tenure, VMware has become one of the most active companies in that sector, and he's had a front row seat on that. So great to get your perspective. And last but not least, Shankar Chandran, Vice President and Head of Samsung's Catalyst Fund. Shankar's charge is early stage disruptive venture capital investment in high growth sectors. Before joining Samsung, he was a founder of another venture fund called Panorama Capital, and Shankar came up through Applied, excuse me, and is the primary inventor on 8 patents, so I think you have all of us beat here on the panel. So we heard a little bit about some corporate venture capital this morning in a couple of the presentations, so I want to pick up on a couple of those themes. Maybe as a way to transition from the introductions, I'll just start by saying, is your mandate, and Glenn will ask you to put on your investor hat, not your M&A hat for this presentation. I'd like to know if your mandate is primarily strategic or primarily financial when you're looking at these investments. So anyone who wants to jump into that.
Well, I will say that when we do a minority investment, obviously in the end we want to have a financial return, but for us that financial return includes however the information, the knowledge, whatever we get out of that relationship with that target or that investee is spread throughout the company. So
how do you quantify that?
Here's how we do it. We don't quantify it. We don't quantify it, but we have a sense, is it going to be a good investment or is it not going to be? So for example, right away, if I don't see a relationship between that company and what we do, I wouldn't be involved at all. I see great opportunities, but I say that's not for us because it doesn't help us. There's nothing we are going to learn from that company that could help us in the least.
I think we do a little bit differently, and we sort of dished about this backstage. But so at Intel, there's this continuum that goes from an eyes and ears investment, which is something that's highly disruptive. It's probably emerging, so we don't have a business unit that focuses on it yet. But Intel, given the gamut of products, kind of cares about most things in tech. And then sort of at the other end, you have BU supported, where there might be some commercial agreement. Maybe it's gap fill in technology, and it's highly strategic. And so for us, we tend to look at a financial return just the same way everyone else does, which is what's the current value at the time of exit and what did we get, dollars in, dollars out. It's very hard over time to say, well, how much dollar value got created from this relationship. And I think, and again, this is an issue I think we've probably all had to deal with, which is it's strategic when you write the first check, but what happens when it's time for the second check, the third check, and you don't even make products in that market anymore? You know, are you still supporting the company? And for a persistent venture program, you do have to continue supporting that company. So it, you know, kind of, but at the time, it was strategic. So, you know, we tend to not, fortunately, not punish the investors at Intel by measuring that quite specifically.
Let me put it this way. For us, it's very strategic to make money. So, so every company we look at needs to be in our strike zone. But now we are a very large company. We are a $200 billion a year revenue company, which does everything from cell phones to TVs to memory chips to, you know, to washing machines, which means a lot of things out there are very strategic to us. Now, the company can impact us in multiple ways. Sometimes there's a return on the actual money we invest in the company, and we look for that base case in every single investment. However, in a lot of different cases, in a small fraction of the companies we might invest, we might find it to be so strategic, few years down the road, we might acquire them. And they may become real business lines like you talked about, Glenn. That happens, and it happened to a couple of companies in the last 12 months. We acquired SmartThings and LoopPay. They were both investments from Samsung before they were acquisitions. So that really impacts our strategic level where we play with other large competitors. So we really think about it multidimensionally, but it really is important that the company on its own should be a star.
Yeah, and I would just echo that the strategic impact is important in many different ways, because sometimes we'll fund companies just to help an ecosystem, eyes and ears, as you will, and we're not actually measured by whether we make a return or not. So, you know, I guess for better or worse, we have the advantage of not losing our jobs if we make some bad investments, but
I am always measured on that.
Well, how do you, in terms of compensation though, when you are a true separate, when you're a separate unit, do you get compensated based on the return, or how does that work actually for you guys?
It does. It does. So the way, think of it this way, as Christine pointed out, the fund has to survive on its own. The fund has to have the ability to build a portfolio of companies that are returning the fund. The corporation, large corporations don't want to keep opening up their balance sheets to start a new fund. When you have a pretty large fund, and I think Intel Capital is probably one of the largest funds out there.
And we invest off the balance sheet, you know, structurally, but it's the same, you know, thought. And I think most folks, we need to be cash flow neutral generally. So you need to do that.
So, but do you get hurt then because whether or not you're giving value, but it's not being included in the total what the return is for the investments you've made? So do you feel that versus working out in the valley at an independent, you could move there and you get the full value. Here you're giving value, but you're not getting it personally.
Well, that's a private conversation there, Glenn.
I have an opening.
Yeah, well, what tends to happen, and I think this is, you know, again, it sort of ranges around, but you can get compensated in different ways, and I know some folks do a carry proxy inside the organization that looks a lot like a sales commission based on exits. Some folks do it based on strategic value, so you know you have RSUs and all sorts of, because if you're big enough to be investing in companies, you're more likely to be public than not, and you're more likely to have all sorts of creative ways to compensate staff. And so, you know, it's interesting. I know my original offer from Intel, I'm trying to think, what can I talk about? My original offer from Intel included, I think, 8 different forms of compensation because they're trying to push the strategic and push the IRR, you know, and that was a huge piece, was IRR specifically. So, I mean, I don't know about you guys.
Quite similar. So think of it this way. I've been on both sides of the table. I've been a partner in a venture firm. You know, and I'm now responsible for an early stage investment fund for Samsung. Here is the thing. At the end of the day, it's pay for performance, right? In an independent venture firm, you don't make carried interest until the fund returns money to the LPs, and that's a very long way off. So how are you going to incentivize your folks for the first 7 years? It's pretty hard, right? So we're all in the deal business because we like to invest. We like to find the next star. We like to really look for companies that we think is going to change our career as well as make impact wherever we are. So I think that's a typical deal guy. So I think the gratification is if you're able to think about pay for performance, long term, and for the portfolio as a whole, it drives the right kind of behavior inside a corporate venture firm.
So, Shankar, I think what you're saying is, if I'm trying to unpack a little bit your comments, I think you're saying that when you're compensated or when you're rewarded or measured, the measurement is, it's a mix between what you're bringing to the company from a corporate or strategic perspective and also the returns.
Absolutely.
Yeah, okay.
Yeah. And just to point out something that's, again, it's common sense. Like if you're investing off the balance sheet as versus being in a separately structured fund, I mean, if it's not a fund, there is no partnership, there is no carry, right? So you have to have some proxy for that performance.
So before the sessions this morning, I was talking to somebody who had a couple of startups, and he said, I took corporate venture in my last software company, and there were two large enterprise software companies that had invested, and he said, I would never do it again. And I won't do it because even though they told me I wasn't taking a side, and I never saw that I was taking a side, the market perception was that I was taking a side, and it limited my ultimate exit opportunities. Ask them that. So I'd like to turn to you. What do you think about that comment that I heard this morning? And
Could you characterize that a little bit more? How did that impact his exit value?
Well, he seemed to have done pretty well, so I wasn't, I don't know, but I think the kernel of it was, there is a thought among some that, even if you have an investment program within a corporation that is more or less separate than the main corporate strategy, that being associated with that company will have an impact on ultimately how you exit or what you do. And I'd love to get your perspectives on that. And when you're asked that by prospective investee companies, what do you say?
I'll say, for one, I've worked in M&A a long time. We've looked at a lot of targets. We have never once not bought a company because they have an existing strategic investor. Whether friendly or not, it might change how we tactically approach the situation, but it's not going to stop us from buying you or make us pay any less.
And I think, towards that point, I think it depends on what kind of investor it is, right? And so for example, we just co-led a deal into Brit & Co., and I seriously doubt that, Brit Moran is worried that she now has limited her options because she took money from Intel. It's not relevant. There are reasons we like it, but they're not going to get in the way of the kind of folks that are going to want to partner with her or invest in that company.
So here is my my personal view, not so much as a Samsung Electronics perspective. As an entrepreneur, you really want to ask yourself some tough questions. It's not about whether it is one corporate, whether I should take corporate venture capital early days or later days, or if I should not take their money at all. It's about who you're partnering with. I think there are great VCs and there are not so great VCs. There are great corporate venture capitalists or not so great corporate venture capitalists. It's typically the individual. Now, there are some key strategic value that I think any corporate venture capital would like to bring to the table. And I think Intel's been there for 30 years. They're probably the pioneers in the business. And I think they've done a great job over time. How much is it? $12 billion or so? Over.
It's ridiculous.
Yeah, a really large number. So they are almost, a lot of the successful companies took money from them. So there's a great track record there. You can go dig up and talk to entrepreneurs who took money from them. So go do your research. Talk about who you're partnering with. Ask the tough questions about what the corporate venture capital firm is going to bring to the table for you, and are they right for you at the right time. So it's really, it's up to you.
Yeah, really, it comes down to what does the corporate VC bring to the table? And it's funny, the biggest conflicts are management many times knows and understands the benefits they'll get from anybody on this table or here on this panel, but sometimes the VC isn't quite as understanding of that benefit that's going to come, and they have a fear about that it's going to hurt them in the exit. So sometimes there is that conflict, and I've been kept out of investments where management would like to have done it, but the VCs just did not want to have that strategic party under the tent.
And realistically, it's very, very rare to have a right of first refusal from a corporate nowadays. Particularly anyone who's doing investments at any pace. You can't do that and get deals. You won't get exits.
Here is one more thing I've heard over time. A lot of VCs tend to advise entrepreneurs don't take corporate venture money early on, et cetera, et cetera. It's for a specific reason that sometimes the corporate venture capitalist doesn't quite stay on that job for a very long period of time. And sometimes corporate venture firms come in and invest during the boom times, and then they go away and things like that. The idea being that individual firms stay for 10 years, 15 years until they fully liquidate. So these guys are there for a long time, so they can partner with them for the long term. But then again, there are multiple firms which have invested during good times and bad times, and not just gone away from the business. We've done investments since I think about 1999. We have about $1.4 billion and several hundred companies that we've invested in, and we've invested consistently about 50 companies a year. So I think you want to ask those questions. Are they going to be around for a long time? Can I work with this one individual? And is it going to be strategic and valuable for me as an entrepreneur? So those are the questions you want to ask.
So I'm hearing, know your investor when it comes to that question. So Eddie, I'll pick on you a little bit as probably the newest, in terms of the length of period of time that your company has been active in this space. How do you address that question when it comes up?
I think that one of the big benefits that we can provide, especially since we're new, we don't have a formal separate fund structure. We can write a check for $100,000 for a guy in a garage. We can write a check for $40-50 million in a Series D or Series E, and we've done all of those things. We can also move much quicker. I think the decision-making body, at least at VMware, that can quickly decide to write a check based on limited diligence is a huge advantage. And I think our money's good.
Fair enough. So let's shift gears a little bit, and this is going to pick up on a few things that each of you have said. When I started doing this, it was very simple. You had a couple convertible notes at the beginning, then you had a Series A through D or something, and then the strategic investor came in at the end, and that was it. And usually they came in as a minority investor in the last round, and they didn't ask any questions, and that was kind of the end of the story. It's very simple. Totally different now. So you'll have, Shankar, your fund clearly says that you're looking for very early stage. Christine, I know you've been making early stage investments. I guess my question is, when you introduce corporate venture capital at different stages, that seems to present some challenges. One, does it become disruptive to kind of the traditional venture model in your view? How does it fit with the traditional venture model when you guys are out making seed investments or Series A investments, leading rounds as opposed to just following rounds? How does it change the dynamic?
Yeah, and I'll speak to that a little bit first. And there was a reason that I got recruited at a first round to join Intel, which was they did want to start making earlier stage investments, and they did want some expertise in the organization around, well, it's a different set of norms, it's a different set of practices. How do we find that place in the middle so that you can effectively integrate, right? So if the biggest, and like I said, every corporate investor has the thing they do that's special, and for Intel it's revenue acceleration and the business development we do. But a lot of very early stage firms just don't have someone to take advantage of that. So then you have this whole navigation like, okay, well, how do you support, four people and a dog, right? I think another one is, again, when you have these public companies and you're doing reporting, you have to do evaluation of every investment every quarter, which can be very hard. Some of these people don't generate numbers once a quarter. What's that about? So there's some things like that where, again, you've kind of got to figure out, all right, how do we manage our expectations and how do we sort of coach people through this process so that we can have an effective technical relationship and get to the good fun stuff, right, about growing the business. So I do see a lot of investors coming in earlier from the corporate side. There are some, and I will not name names, they're not here. But there are some who I've seen go and they'll salt around, some 200K checks at a demo day. And they haven't done a lot of it. It's experimenting with seed investing. So they're on the list, but as someone who's more engaged, because it's more work, I have fun, I don't see them very much, right? Because they're not, their structure isn't set up to support a company that they don't have a big piece of or they don't have a big commercial relationship with. And so I think it's important to understand when you do take a little bit of money, well, if you just need money, I think you should always just take it, and if they're quiet, that's fine. But if you want something more, understand how they're set up to support you. So have they set up a specific accelerator program and you're part of it, and what are your expectations, what are theirs? Because you want to make sure you don't have a mismatch on that.
I'll add on to that. So our early stage effort is relatively new. So Samsung has been investing in startups since I think about 1999 in a very regular way. Most of our investments tend to be in the US, Europe, and Israel. Half the investments in the US and say 25% in Israel, 25% in Europe. But our early stage effort started about 3 years ago. And the reason why we did that was this. We felt that the earlier investments, the mid-stage investments, and the late-stage investments were really done when our business units got excited about a company, right? They wanted to differentiate their products out in the market. They found a company that they wanted to work with. They wanted to get really close to it. The company had, needed cash, especially when they were growing. If you're a chip company and you're getting on the Samsung mobile platform, it's not easy because you're going to have to make 500 million of those a year, right? So it's really, really hard to ramp up your efforts. So they needed cash. But then we realized that we were missing out on a lot of the early stage disruptive ideas. And for us, at the end of the day, when Samsung needs to differentiate itself in the marketplace, we really need to be looking at some early stage ideas in order to bring them in much ahead of our competitors. Now, what does that mean? So the big trade-off is risk reward when you go from early to late stage. The early stage deals tends to have a lot higher risk. You're likely to have, say, 70–80% of your investments fail. And big corporations tend not to understand that level of failure rates. Venture capitalists do, but big corporations don't. So we set up an independent early stage effort, which I'm responsible for, that does early stage investments, that fully understands that you may have a high failure rate. So now, is it good or bad for the venture capital industry? It turns out that several of the ideas that we are looking at tend to be pretty collaborative with venture capitalists. The reason is they would like to get an endorsement from an early customer like us pretty early on. It helps mitigate risk for them. So it's worked well in that case. In some of the cases, there's so much technology risk in the companies that we invest in, we were willing to go alone. We were willing to do seed investments, which may or may not succeed for the company, but we've seeded companies that later on attracted traditional venture capital just because they were not willing to go that early. So it works well.
So I'd love to give anybody in the audience a chance to ask the hard questions of our corporate venture capitalists. Yes, sir.
Can you talk a little bit about taking board seats? I know it felt not to.
So question was about taking board seats, and maybe some people say not a good idea to have a corporate venture capitalist on your board. Maybe some would take a different view. So what do you guys think?
We do take board seats, so.
I prefer to have an observer seat and not worry about the litigation.
Likewise. So here is the thing. When you're a member of the board, you have a duty of loyalty and care to all the shareholders, and you want to take it very seriously. I've personally sat on 15 boards in my career in the past, and I take that very seriously. Now, as a corporate venture capitalist, it becomes really tricky unless you have the ability to understand the conflict and remove yourself from certain situations, and you really work hard on that one. Otherwise, it's not too much fun. So what do? We have a large volume of investments. In some cases, we try to find a neutral party. We might ask for a board seat, but we don't take the board seat. We might ask somebody else to do it for us, who turns out to be another independent person, right? In some cases, where it's really strategic to us and we can find someone senior in my team to take a board seat, we do that. In most of the cases, we do observer.
And I think having even just a board observer in the room when you're having your discussions, especially if that corporate venture capitalist designates somebody that is, a product or R&D leader within their organization, if they're central enough to whatever ecosystem you're in, having that insight rather than just having to, outwardly ask questions, just having that during the back and forth is very valuable.
Any other questions? Oh, why don't we go Heidi and then in the back?
One of the love having corporate investors, but don't love it when the corporate investor ties the corp dev to the biz dev, and that's a
we do both kinds. And so for example, an eyes and ears investment is incredibly unlikely to have any kind of agreement with Intel. It's just too early. The business unit doesn't care yet, right? It's too small. And then there are ones that are incredibly strategic, and yeah, it's probably going to be tied if we're writing a $50 million check. There's probably going to be some deal. so I think the smaller the check, the less likely it is to get tied. And when I have had that come up on one of my deals, and what we ended up doing, again, I think a lot of it's driven by the individual who's driving the deal, who's going to be the person working with the company. What I've done is basically like a 1 to 2 page. The intention is to do something kind of like this, and we'll figure it out.
So we only have a minute left, and then we're going to get the hook. But I'd love to get your perspective on that question. So tying corp dev and
Stage dependent, actually. Early stage investments, we think of ourselves as Sherpas. I think Glenn used the word, which is how do you help the very early stage company be on an on-ramp so that eventually they get to work with a large company like us? Because navigating us is really hard. I'm the first one to admit it, right? So there is really no business agreement there. But I think a later stage company that is right there having a product, and for them the real value is they need to be on one of our platforms, high volume platform. There, it is a no-brainer to do a business agreement. It's going to create you value as a venture capitalist. So,
It's completely fact specific, and sometimes we have it, sometimes we don't. It really depends on the nature of the relationship. I will say sometimes it comes the other way, where the companies come to us and they're saying, please, will you do a business development thing? And we'll say, well, maybe, and this we'll let you have equity.
Yeah, the problem I've seen much more the other direction, where they want to lock down the thing besides the cash.
Right.
So can we sneak in one more question before the dreaded X comes up? Real quick. Sorry. Oh, okay, excellent. So the same question's been asked and answered, as they say in the court. Oh, one more, real quick.
So thank you. Earlier we talked about how a lot of large corporations are returning cash back to the shareholders and not being able to drive innovation.
Yeah.
And so for large corporations that have innovation office or venture arms, are you set up to sort of target for the same amount of return as what they would like to target to the shareholder without the return back?
So let's take, who's going to take that? And that will be our last concluding comment. And thank you for asking that, because that was on my list as well. Okay, both of you.
Yeah. So we benchmark. So we're compared to the return on R&D spend, and we're compared to top quartile venture returns. And generally what happens is we're doing better than top quartile, and we're probably not as good as R&D. But we expose a lot of things.
So you measure it, though? Yeah.
Oh, IRR is measured on the individual. I have my own IRR sheet.
No, I meant on the R&D and what you're achieving.
R&D
yeah.
is measured, yeah.
Absolutely.
R&D is measured.
Yeah.
No, I have no comment about our future use of cash.
Spoken as a public company executive. And Shankar, do you have any comment on this, or Eddie?
it's really, here's the thing, right? I think it's really hard to judge. It's impossible to give you a direct answer. The thing is, how do you judge the value of early stage disruptive ideas and what it means to your corporation, particularly when you're a $200 billion a year revenue company? You can't, right? So the question is, could you think about an alternative to your own R&D? We spend $15 billion a year in R&D. We don't invest that much. We invest a pretty small number compared to that. I think we invest about $100 million a year. For us, $100 million a year spread around in the most technologically intensive hotspots around the world helps us get involved with companies at a pretty early stage, and that might spur new business units for us down the road. So that's the way we think about it.